So here in chapter 17, well, we're going to continue stat sampling as we saw it from back in chapter 15, but with a little difference. In chapter 15, we were looking at test transactions in which we have binomial distribution, such as is the internal control followed, either yes or no. And we would do that when we were doing tests of controls. But today we're going to be dealing with tests of details. So tests of details, the primary test of detail that we will see, and that you would also see on the CPA exam, is this. We're going to have a test of detail where we are looking at the ending balance of an account and trying to see, is it fairly stated or not? So as we deal with a distribution here, we're dealing not with a binomial distribution in which there are only two possible right answers, but instead with a continuous distribution in which the answer could range up to infinity. So again, accounts receivable, the primary thing that we'll see in here, and the primary test of detail that we will be doing will be confirming accounts receivable. Let me just turn this on, a light on projection here. You can see what's up on the board. And as we think about accounts receivable, in the general ledger, we have one big accounts receivable control account. And it's made up of a bunch of individual customer accounts receivable. Well, this ending balance in here, as well as the ending balance in each individual customer's little account receivable, which looks just like this, that number could range, well, theoretically, from even less than zero if the account has been overpaid, to up to infinity. So it's a continuous distribution here. And in tests of details, we're trying to find out what is the correct ending balance. So that is what we're worried about there. With that ending balance, well, the big accounts receivable control account in the general ledger, since it's made up of individual customer accounts, we plan to confirm those customer accounts as a primary test of detail when it comes to accounts receivable. So we'll confirm those individual accounts receivable, or at least a sample of them. So it may be too much to confirm them all, but at least we will confirm a sample. So in this chapter, we're going to see which of those individual customer accounts receivable we will sample to confirm. So we will send out a special type of statement from us to the customer, which is this your correct ending balance or not? Customer says either, yes, it is, or no, it's not. Okay. So we're going to have that. So what's accounts receivable? We do have something that we need to finish up with accounts receivable that I haven't done yet, but I will for you online, which is chapter 16 about confirming individual accounts receivable. So I'll talk more about that once I've finished this chapter here. So the ending accounts receivable balance, what is it? Well, we're trying to determine that. It would be very nice if we could confirm each and every individual customer account receivable, but that sure is a lot. Instead, we're going to confirm a sample of it. So we'll pick that sample out and we'll draw conclusions from it in this chapter. And of course, we will do so statistically. So in this chapter, again, if you're rusty on statistics, don't worry about that. We start everything we need from scratch. But a lot of things are going to sound familiar from the previous chapter anyway, so not too different. So let's first look at some background information here, and then I'm going to get into an example of this. So I'll put some numbers to it. They're not very difficult. So we'll be studying statistical sampling, as we know, for tests of details in this chapter. And we can recall the tests of details or substantive tests. designed to determine whether the ending balances of real accounts are fairly stated. We learned that in the first auditing course. And again, we'll be dealing with continuous distribution, and tests of details help the auditor to assess plan detection risk. So plan detection risk, the risk that there's material error out there and we don't find it. And that again is something we studied about in the first auditing course when it came to the audit risk model. Well then, we just studied attribute sampling in the chapter 15, which deals with binomial distributions, as we know, in which there are only two possible responses, yes or no. An attribute sampling is appropriate for test controls to determine whether or not a control is followed, and for substantive test transactions to determine whether or not the dollar amount of an individual transaction is appropriate. We can note these tests give the auditor information to assess control risks, so the risk that internal control is not working, and plan detection risk, the risk that there's a material error out there and we don't find it, respectively. And we'll study two different types of stat sampling for tests of details. Monetary unit sampling, also known as probability proportion to size or PPS sampling, and variable sampling. And we'll be determining the amount of error in our sample and then projecting this error to the total population, total account balance, in other words. So what is an error? It is defined as book value less audited value. So if we were auditing an individual customer's account receivable, we found the ending balance to be $5,000. The audited value, that is, what we think is correct. And the client has $5,500 listed on the books. That $5,500 is the audited value. The $5,500 is the book value. Whereas the audited value is $5,000. Just make sure I've got that on my camera here. So the audited value is $5,000. It's less. Generally, what the client has is an overstatement. We know why. I love to overstate accounts receivable like any other asset. So in this case, the error is 5,000. We will assume it's positive. Well, there's no negative sign. Generally, if a number has no sign in front of it, it is positive. A negative number has a minus sign or it's in parentheses. But this could easily be negative as well. So the error is positive 500. In other words, the book value is overstated. If it were negative, the book value would be understated. Such as, in this case, the book value would be 4,500. That usually doesn't happen with accounts receivable because clients would love to overstate them. So again, the error defined as book value less audited value, and we noted that an error can be either an overstatement or an understatement, which would be a negative amount is computed here. By the way, in the way of terminology, error is the same thing as misstatement, same thing as exception, same thing as deviation, same thing as occurrence. I like to use those terms interchangeably because, again, if I use one and you see another, bless you, on the CPA exam, you'll think, whoops, I don't know what they're talking about here. Then E, often, as we know, population are stratified. In other words, divided into layers or strata. And different sampling plans then apply to each strata. For example, accounts receivable could be divided into strata according to size. So to large balance accounts, medium balance accounts, and small balance accounts. Usually small balance accounts, we stratify them out. We don't even bother confirming accounts receivable in this very lowest strata. They're just not big enough. So a little bit more about that. The auditor would want to confirm most, if not all, very large accounts receivable with positive confirmations. A positive confirmation says, is this your correct balance or not? Return this confirmation to the auditor, regardless of whether this is the correct balance or incorrect. They're expensive that way. Then the auditor would want to confirm a smaller percentage of small accounts receivable by using negative confirmations. Those say return this confirmation to the auditor only if your balance is wrong. Otherwise, if you don't return it, we assume no news is good news. We assume it's correct. They're cheaper. And then the auditor probably would not want to bother confirming accounts receivable with relatively smaller zero balances. And he or she may also pull out related party accounts receivable as a separate stratum. Based on characteristics instead of dollar size, we can do that and confirm most, maybe even all, with positive confirmations because they're very high risk and they're worth it. And we will see that much size-based stratification can be eliminated with PPS sampling because it has a neat trick. It's going to sample individual dollars in account balances. And again, I will show you. It's a neat little way of doing things. Then we can recall the following facts from statistics. First of all, repeated samples will give you different sample means. Remember that sample mean that we saw before it could be X bar or E hat, depending upon the author of your stats book. But that's simply the amount of error we think is in the sample. If we take repeated samples from the same population, we get different sample means. And that's because there's noise or variability in sampling. It's a stochastic process. You might recall that term from the first auditing course. Thus, when we take a sample, we have the following sampling risks, also known as sampling errors. We saw these last time too, but I'll go back over those. One is type 1 error. This is the risk that our sample results confirm our hypothesis when we would have found that the hypothesis would have been refuted if we'd been able to examine the entire population. So our sample looked good, but the entire population wasn't good. That can happen even if we exercise our best due care. So in our case, with sampling accounts receivable, we confirm a sample of them. We conclude that the ending total account balance is fairly stated. However, had we been able to examine every account receivable, we would have found the total balance not to be fairly stated. So again, sample is good, population's not. Type 1 error thus increases the auditor's business risk. Type 1 error is often called the acceptable risk of over-reliance, especially when pertaining to internal control, or the acceptable risk of incorrect acceptance, especially when pertaining to test details. And the auditing standards also refer to this risk of type 1 error by that confusing acronym, assessing the acceptable risk of assessing control risk too low, but they leave off the TL for some reason. So anyway, this is the risk of type 1 error, or sometimes in stats called alpha risk. It's always with us unless we examine the entire population. And the more items we examine, the lower this risk will be. It ties into the fact that we cannot guarantee absolutely precise results from sampling. We're really getting ballpark figures. So the other one, the risk of type 2 error. So in this case, just the opposite. Our sample's bad, but the population's good. So it's the risk that our sample results refute our hypothesis when we would have found the hypothesis would have been confirmed we've been able to examine the entire population. So again, sample is bad, entire population is good. We got bad, draw the cards. For example, we confirm a sample of accounts receivable and conclude that the ending total accounts receivable balance is not fairly stated. However, had we been able to examine every account receivable, we would have found the total balance to be fairly stated. Type 2 error is also called the acceptable risk of under-reliance, especially when pertaining to internal control, or the acceptable risk of incorrect rejection, especially when pertaining to tests of details, but it's type 2 error, or sometimes in stats called beta error. Again, it's always with us unless we examine the entire population, because we always have this situation. Then C. The auditor must specify how much of each of these risks he or she is willing to accept when playing the sample. Now, faced with a scenario regarding type 1 error, the auditor must be able to document sound sample playing, etc., in order to refute any claims of lack of due care, because we said everything was okay in our sample, but the population really isn't. And also, after all, neither type of sampling error reflects negligence on the part of the auditor. The sampling risks are simply an inherent part of any type of sampling. Both types of sampling risk can be reduced by taking a larger sample, as we'll see in sampling tables. In fact, the only way to reduce both risks to zero is to, once again, sample every item in the population. That is the goal of audit software and artificial intelligence, so maybe one day, but not everywhere yet. So for now, we stick with stat sampling, but at least we know the good news to that. Not as much statistical sampling is tested on CPA exam today as in years past. So that's a good thing, unless you just really like this stuff. Okay, that's okay. Gotcha. Now on number 2, something that we've seen before. Well, this sample mean is actually a point estimate. It's just one little point that we estimate, which we will project the entire population. And we must form a confidence interval around this mean to reflect again the stochastic nature of sampling. This is actually an allowance for sampling error. And we normally calculated this in your stats course by multiplying by the standard deviation of the sample by a z-score. In doing so, we had to express confidence level in percentage terms, which is 1 minus the acceptable risk of type 1 error. And use this confidence level to look up the appropriate z-score. Don't worry, we're not going to do it in this class. But anyway, usually in statistics, as we said a couple of weeks ago, the acceptable risk of type 1 error was specified as either 10%, 1%, or sometimes 5% in the middle. So with the so-called confidence level, we would have either 90% if we had an acceptable risk of type 1 error of 10%, or if acceptable risk of type 1 error happened to be 5%, we had a 95% confidence level, or, excuse me, if the acceptable risk of type 1 error were only 1%, we had a 99% confidence level. So here's a brief example. Let's assume that we sample 200 accounts receivable out of a population of 5,000 accounts receivable for a client with book values of $45,000 and $1.5 million respectively. And we confirm this sample of accounts receivable, and we concluded that the appropriate audited value was $42,000. So in other words, it looks like this sample is overstated by $3,000. So if that's the amount of error in the sample is $3,000, the book value appears to be overstated. Again, that's the usual case with accounts receivable because clients would love to overstate the book value. So we can project this error of the population as follows. So in our sample, we found misstatement of $3,000. That was out of a total book value of the sample of $45,000. So on average, we think the accounts receivable have been overstated by 1/15. That's what 3,000 over 45,000 reduces to. So if we project this 1/15 misstatement the entire population, we can multiply by the population book value of 1.5 million. We get $100,000 if we do. So thus, based on our sample, population of accounts receivable appears to be overstated by $100,000. Of course, repeated samples would give us slightly different results due to the stochastic nature of sampling. We must thus form a confidence interval around our estimate to reflect an allowance for sampling error. And assume this auditor accepted an acceptable risk of incorrect acceptance or type 1 error at 10%, and that the sample standard deviation multiplied by the appropriate z-score is $5,000. And yes, I just made that number up, but that's okay. I don't want to worry about z-scores or standard deviations. We thus believe the true range of error in the population based on our sample is within 5,000 of 1.5 million, I'm sorry, of 100,000, or from 95,000 to 105,000. So let me just show you that in a confidence interval, which we saw back in stats. It's not difficult. So if we had a confidence interval here, we know it's a nice normal distribution that we will work with. Symmetrical, it's bell shaped, that's great. Here's what we would do. This X bar or E hat, whichever you would like to call it, we would put right in the middle of this. So based on our sample, we think the accounts receivable are overstated by 100,000. But if we were able to examine the entire population of accounts receivable, do you think that the amount of overstatement would be exactly 100,000? No. If it is, we better go over to the Stop and Shop or Stop and Go or whatever it's called across the library, which is where Judy Hilscher used to go to buy her lottery tickets. We might get lucky, luckier than she did because she's in prison. And we would not be buying them with embezzled funds. So this true population value, it could be a little bit more or it could be a little bit less. So the entire population can have a little bit less than 100,000 of error, or a little bit more than 100,000 of error, or again, if it's time to play the lottery, exactly 100,000. So what is the range in which we think this true population value of error is going to lie? Again, if this were a stats class, we would be calculating the standard deviation of the sample and multiplying by a z-score. Well, that will be done for us in some tables in this class, so we won't worry about that. So I'm just going to assume 5,000 for simplicity is this range that we have in which to allow for sampling error. So the true amount of misstatement of the population could be as little as 95,000 or as much as 105,000. These would be the lower confidence limit and upper confidence limit. Sometimes the name is a little bit different in stats, but same thing. This is how little we think is in the population in the way of error. Here's how much error might be in the population. So the true population range of error could be as little as 95,000 or as much as 105,000. Again, we're not sure unless we examine every eye in the population. And there was a risk of type 1 error of 10%. So there's a 10% risk that the true population value of error is outside this range. In fact, a 5% risk, dividing it in half, that the true population amount of error is less than 95,000. Or a 5% risk up here that the true population amount of error is greater than 105,000. Don't have to worry about that too much in this class, though. Then in G, in performing tests of details, the lowest figure of 95,000 is called the lower misstatement bound, lower confidence limit, same thing. Least amount of error that we think is in the population. While the upper figure of 105,000 is called the upper misstatement bound, or upper confidence limit, so the maximum amount of error that we think is in the population. And the auditor will compare these to the tolerable misstatement he or she is willing to accept in accounts receivable. We'll see more about tolerable misstatement later. It's based on materiality. In other words, it's the maximum amount of error that we will accept in the population. So up here, this tolerable misstatement, the amount of misstatement that we will accept in the population. So if the tolerable misstatement is either less than 105,000 or equal to or greater than 105,000. Okay. If tolerable misstatement is less than 105,000, we will conclude that the population is not fairly stated. Because tolerable misstatement is the maximum amount of error that we're willing to accept in the population, still see as fairly stated. So if that tolerable misstatement is anything less than 105,000, we're going to say, oh, we can have up to 105,000 of error or misstatement in the population. So the population is not okay because we're only willing to accept up to 104,000, let's say, of error. That would be if 104,000 is our tolerable misstatement. On the other hand, if tolerable misstatement is equal to or greater than 105,000, we will conclude the population is fairly stated. And why? Well, if total misstatement is 105,000 or greater, this amount is less than or equal to what we're willing to accept the way of error. So there's only $105,000 of misstatement of the population, or I should say a high of 105,000, a possible high. But let's say total misstatement is 110,000. We're clearly willing to accept more than this maximum total of $105,000 because we were willing to accept up to $110,000. So in that case, our conclusion is the population is fairly stated. You can go ahead and give the client a clean opinion if nothing else is wrong, if nothing else materially wrong. On the other hand, up here, tolerable misstatement is less than 105,000. Population of accounts receivable is not fairly stated. In that case, we cannot give the client a clean opinion on the financials unless they correct accounts receivable, or at least correct them enough so that they bring the upper confidence limit down to tolerable misstatement or less. So shall we say they have to fix accounts receivable enough in that case for us to give them a clean opinion? Does that make sense so far? Okay, so with that background information, let's put it to work and look at some examples here. So let's look at an example of monetary unit sampling, sometimes known as PPS or probability proportional to size sampling procedures. Here's where it gets its name. We will be sampling not individual accounts receivable. Instead, we're going to be sampling individual dollars in the accounts receivable balance. So the bigger an individual customer's account receivable is, the more dollars are in it, the more likely a random number is to match up to one of those dollars in that customer's account receivable. So the bigger the account receivable is, the more likely it is to be picked by a random number and sampled for us to confirm. So if that makes a little bit of sense, that's all I need for you to have at this point. It automatically stratifies according to size. Does that make enough sense for now? Doesn't have to make total sense because I'll show you more of it. You get the hang of it, right? Okay, cool. So yeah, the bigger an individual customer's account receivable is, again, the more dollars are in it, the more likely it is to be picked by a random number and therefore sampled by us to confirm. And that's just what we want. So this is a really neat way of doing things. All right, so going through here, I've got some steps which we have for PPS sampling. These are also in your book. I've got steps here in italics, and then I tell you about things just underneath each. So the first thing to do is state the objectives of the audit test. Well, it's determine whether the ending accounts receivable balance is fairly stated. And we'll thus estimate the error in the total ending accounts receivable balance by confirming a sample of accounts receivable. Then decide if audit sampling applies. Well, yes, it will. It's a safe bet in our class as well as in any problem you see on the CPA exam. So as we know, PPS sampling is appropriate to estimate the ending balances of real accounts as a part of tests of details. Yes. Then C, define the misstatement or error conditions. So an individual account receivable will be misstated if its book value does not equal its audited value. And the audited value is determined through analyzing the confirmations returned by the client's customers. So that audited value is the quote unquote correct value. Then define the population. Well, the population would be recorded accounts receivable, the ones clients have recorded. We cannot sample unrecorded accounts receivable as we draw the sample for the client's books. So if there's an unrecorded account receivable, tough luck. Accounts receivable are incomplete and we have nothing to confirm. So as always on client books, completeness is an issue because something could be left off. either intentionally or unintentionally. With accounts receivable, probably unintentionally, because clients would love to overstate the balance of accounts receivable. So they're going to list every single one they can. On the other hand, if we were confirming accounts payable, which we can also do by PPS, well, if accounts payable are incomplete, being a liability, that might be intentional because clients would love to understate payables if they could get away with it, like any other liability. So we can't sample unrecorded accounts receivable as we draw the sample for the client's books. Further, accounts receivable with zero balances cannot be sampled using PPS as there are no dollars to sample. Well, if we have a zero balance account receivable, do you think we usually need to confirm it anyway? No. Again, the client's motivation is to overstate receivables, not understate them. So we usually don't bother confirming small or zero balance receivables. Now, if we were talking about payables, what might we say about confirming small or $0 payables? Right, we probably should, just to make sure. Yes, this is the correct balance because clients love to understate payables. So quite frankly, stratification according to size is more important with receivables than with payables. Now further, the auditor may pull out a separate strata, accounts receivable which are very large, very small, credit balances, or related party, because they're all very high risk. These would not be considered to be a part of the population. Well, let's assume the book value of the population is $1 million. We'll need that for later. Then E, we will define the sampling unit. That's $1 of the cumulative accounts receivable balance, as we'll see. So again, the larger the individual customer's account receivable is, the more dollars are in it. So the more likely it is to be picked by random numbers because we'll match random numbers up to these individual dollars. Then in F, we'll specify the tolerable misstatement. Well, tolerable misstatement is the amount of error the auditor will tolerate in the ending account balance and still conclude it's fairly stated. So it's how much error the we will say is okay. Thus, total error, which is less than or equal to tolerable misstatement, is judged to be immaterial. And that was covered way, way back in chapter 8 in the book. But anyway, for us, let's assume this auditor is deciding upon a tolerable misstatement of $50,000 for both understatements and overstatements. Thus, sampling could determine that the appropriate balance for the ending balance of accounts receivable is between $950,000 and $1,050,000, and the auditor would still conclude that accounts receivable are fairly stated without further adjustment. So as long as we're within $50,000 of that book value of $1 million, we say things are okay. Population is fairly stated. Now, in some cases, the auditor could decide upon different tolerable misstatements for understatements and for overstatements. Then G, specify the acceptable risk of incorrect acceptance or of type 1 error. Well, the auditor must decide upon how much acceptable risk of incorrect acceptance to accept. Quite frankly, it's going to be lower with high-risk clients like ACC clients because we want to play it very safe and not reach the wrong conclusion. Well, let's assume that this auditor decided upon an acceptable risk of incorrect acceptance of 5%. In our tables, we saw a couple of weeks ago, either 5% or 10%. Then H. Let's estimate the amount of misstatement in the population or the expected population error rate. We saw that a couple of weeks ago too. This number will be needed to determine sample size. It may be based either on last year's audit or on a pilot sample, a little rough sample we take. Assume this auditor estimates 1%. Now we need all those to determine the initial sample size. And we'll refer to table 15.8 on page 508, same thing that we saw before. And one figure you'll need for this table is the tolerable error rate. You can calculate that as follows. Take tolerable misstatement of 50,000, divide by the population book value of 1 million to get 5%. So we're willing to accept up to 5% of error in accounts receivable and still say they're okay. So that's how much error rate we'll tolerate. Don't worry about what's in parentheses. And I can either look this up or you can trust me, it's 93 for the sample size. Want to trust me? Oh, okay, that was easy. So trust me, it's 93 in the table. You can look it up easily. And these effects on sample size, we looked those up 2 weeks ago. If you want to look them up again, feel free. Then J, we'll randomly select the sample. So this is going to involve randomly selecting individual dollars out of the cumulative account balance. So we'll recall the random sampling provides means of achieving a probabilistic sample, probabilistic or random, in other words, in which each sampling unit has an equal chance of being selected. So every single dollar in the cumulative account balance has an equal chance of being selected. This thus helps lead to unbiased conclusions. So here's a little example. Let's assume a client has the following accounts receivable in its accounts receivable subsidiary ledger. So these, in other words, are individual customers. So we have account or customer number 1, 2, 3, 4, and 5. Now, traditional sampling and the primary type of traditional sampling used in confirming receivables was something called variable sampling. It's not used much anymore. It did not stratify according to size. Variable sampling would sample these individual account or customer numbers. That makes no reference once again to size. It was not a good way of doing it. Still around, just wanted to mention that. PPS samples according to size, automatically stratifies. So here are these 5 individual accounts receivable with their book values. Here's the cumulative balance. Keep adding them up. So account number 1, book value of $1,500. Cumulative balance is $1,500 so far. Account 2, $200. So the cumulative balance goes up by $200 to $1,700. Account 3, $3,700. So add that $1,700, we go up to $5,400. Account 4 puts us up to $6,300. Account 5 puts up to $10 million, up to $10 million. $10,400. Pardon me, my mind got off on 10 million and my place value too. I kept these numbers small because they're easy to deal with. So now let's go in and sample some random numbers. If we wanted to, we could go to any one of a whole bunch of random number generators on the internet. Or every audit software package has them too. So in this case, we would want to generate random numbers starting from 0 up to 10,400. That will cover all the dollars in this cumulative account balance, ranging from $0, starting just below account 1, up to the very highest dollar, which is in account 5, 10,400. Does that make sense? That's our range. So if random numbers 6,300, 6,513, and 9886 are drawn, Then accounts 4 and 5 would be confirmed. Let's see why. Okay, random number 6,300. That one is just barely an account 4. And I picked it on the border just for intentional purposes. It's an account 4, not 5. Number 6,301 would be in account 5. Does that make sense? Okay. Then we have random number 6,513. That is above account 4's cumulative balance, but below account 5's, of course. Random number 9886, again, way above account 4's cumulative balance, but certainly within account 5's. So we have sampled account 4 once with the first random number. We sampled account 5 twice with 2 different random numbers. So why did we do that? Well, the next sentence tells us. Because PPS involves sampling with replacement. Normally we sample without replacement, meaning that we draw that sampling unit out. However, PPS samples with replacement. So, thus, the effective sample size is 3, but only 2 confirmations are sent out. That's okay. Effective sample size, 3 random numbers. Matching up to 3 individual dollars in the cumulative account balance. So sample size 3, we matched up to 3 sampling units, which are individual dollars in the cumulative account balance. However, 2 of those dollars confirmed were in the same account receivable, which is account receivable number 5. So we don't bug that customer by sending them 2 confirmations. We only send them 1. So 1 confirmation sent to account receivable number 5 and 1 sent to account receivable number 4. But still the effective sample size 3, even though 2 confirmations are sent out. Does that make sense? Okay. By the way, if we send 2 confirmations to customer number 5, they're probably going to get annoyed with us. Probably going to think it's an attempt to get more money out of them. You billed me for the same thing twice. Because a lot of customers, especially individual consumers, they're not very familiar with account receivable confirmations when they get them, and they think it's an excuse for another bill. Yeah, we've also noted how larger accounts receivable, larger accounts, are automatically more likely to be selected for confirmation using PPS, which is just what the auditor normally wants. Good. We stratify according to size. Now, traditional sampling techniques like variable sampling, as I said, would have sampled the account or customer numbers, which do not take size into consideration. Thus, size-based stratification is much more likely to be necessary if PPS is not used. Then we'll perform the audit procedures. This means the auditor will now confirm the accounts receivable selected for sampling. Then those come back to us from individual customers. Then we'll go to I. We'll analyze the misstatements that customers indicated to determine their causes. So why was the audited value not equal to the book value in each of these cases? By the way, we'll also pass this information along to the client as good business practice. I moved that step up from 1 notch in the order in the textbook. Then we'll generalize from the sample to the population. Well, this is going to involve calculating a lower confidence limit or lower misstatement bound and an upper misstatement bound or upper confidence limit based on the sample results. In PPS, the lower misstatement bound or lower confidence limit will reflect the maximum understatement the auditor believes is present in the account, while the upper misstatement bound is going to reflect the maximum overstatement. I will show you these things. So I will be using, once again, a confidence interval And just showing you some things on it. And calculating the lower confidence limit or lower misstatement bound. Whoops, let me just get this in camera range here. So we'll have a lower confidence limit or lower misstatement bound, an upper confidence limit, or upper misstatement bound. We'll calculate these quite easily with what's on the table for you. And we'll still have our X bar or E hat. Now I'm going to have two scenarios. One is when no errors are found in the population, and one when we do find errors. So let me go over first one, no errors found in the sample. Thus, for all the confirmations, if we take the book value, it equals the audited value. Everything turned out perfectly. However, we cannot conclude the population has no error because it may be that we just got a good draw of the cards in our sample. We have a really good sample, no errors in it. But had we been able to examine the entire population, there could still be some errors. In other words, some accounts receivable where book value did not equal audited value for individual customers. The only way we would know that is if we sampled everything in the population. So we must thus calculate an allowance for sampling error, which is that little arrow that I added and subtracted earlier, $5,000 in the earlier example. We've got to do this to determine our lower misstatement bound and upper misstatement bound. I'm going to refer to table 15.9 on page 509 to determine the appropriate precision limit or maximum amount of error the sample indicates may be in the account balance. And the account balances or precision limits, rather, are stated in percentages. Well, no, it's not a very detailed table, and I will show you to avoid interpolation. You might not remember how to do that. That's okay. We'll simply round down to the nearest sample size, which will be 90 in our case. And we said earlier the sample size is, I think we said 100. Let me just double check here. Oops. No, 93. Okay. We earlier said that sample size 93 up here. Okay. So we're going to round down to 90 in the table. It's a bit more conservative. I will show you why in just a second. So this is more conservative because it leads to the higher precision limit. Let me flip over here to page 509 with you. Here's the table from sample size we saw the other day. Or I should go back up, pardon me. Here's the table for sample size right above this we saw the other day. Just to let you know where we got our 93 is up here in this first table, 15.8. That 93, I told you to trust me on, I'll show you where it is, just to convince you. So the expected population exception rate we had of 1%. Tolerable error rate, we calculated quite easily as being 5%. So the intersection of 1% and 5% is a sample size of 93. Then, coming down to table 15.9, evaluating sample results using attributes sampling. So we go, oops, let me admit Hunter. There we go. Hi, Hunter. Hope you haven't been waiting too long there. Have you been waiting too long? I didn't even notice. No one noticed either. Okay, sorry, Hunter.
Oh, you're fine. Thank you.
Okay, you bet. I hope, yeah, I just saw you up there. All right. So what we need is, again, a 5% chance of type 1 error, 5% chance of reliance, same thing. There is no 93 in our table because it's not that detailed. So instead we go for a sample size of 90. We've rounded down. In doing so, we reflect across the top the actual number of exceptions or errors found. Well, we found no errors, so we want this first column. So the intersection of 90 and 0 gives us 3.3. These are percentages. This 3.3 or 3.3% means that up to 3.3% of the population may be in error. I'll show you how we interpret that in just a second. So there's our 3.3. Again, rounding down in terms of sample size is more conservative because if we rounded up, we would have said, well, up to 3.0, 3% of the population may be in error. It is safer to round down because it gives us the higher possible error in the population. 0.3 of a percentage more in our case. Does that make sense? Okay. Just round down, you're more conservative. So let's look at that here next in the notes. So in our example, the precision limit is 3.3%. So the maximum amount of error the sample indicates is, well, 3.3% of 1 million, that's the book value, multiplied by 0.033, same thing as 3.3%, to get 33,000. Thus, both the lower misstatement bound and upper misstatement bound are $33,000. The sample thus indicates the appropriate account balance is well within 33,000 of a million, or 967,000 to 1,033,000. Okay, so in reflecting that here in this low confidence interval that I've drawn, first of all, what is X bar? X bar, if we find no errors, the sample mean of error must be how much? 0. Let me put, some teachers have threatened us with in the past, a big fat red 0 there. Because if you don't do your work, you'll get a what? Big fat red 0. That's right, we've all heard that threat. In colleges of education, that must be what they teach teachers. By the way, one little piece of information. Did anybody read what they're going to be doing at USF? They're going to eliminate the College of Education. They're going to make prospective teachers major in something else. And then if they want, they can get a 5th year of educational classes. So if you want to be a math teacher, instead of majoring in math education, major in mathematics. And then we'll train you in teaching techniques for a 5th year. So I guess pluses and minuses to that. But I think I know what the state really wants to do. Exactly. Let's save money here. You betcha. That's what they're really thinking of. So we'll see. Ouch. Oops. Let me adjust that. It's trying to hurt my ear. All right. So X bar, the sample mean is 0. But again, we reflect on the fact that this does not mean there is 0 error in the population. Instead, there could be up to 3.3% of error in the population. 3.3% of that book value is 33,000. So the allowance for sampling error, we think, would be 33,000. Because again, there could be up to 33,000 of error in the population. So we can have a lower misstatement bound or lower confidence limit of 33,000, or an upper confidence limit or upper misstatement bound of 33,000. So we're saying that the true population value of this statement could range from an understatement of 33,000 to an overstatement of 33,000. How much exactly, we don't know unless we do what again? Sample everything. So again, up to $33,000 in the statement of population. And do these numbers make sense? Okay. Now, what's really, really important is to compare this to tolerable misstatement. And tolerable misstatement, make sure I get all this on my screen here. With tolerable misstatement, we bear in mind it is 50,000. So if I put tolerable misstatement down here at the bottom, how much misstatement we're willing to tolerate in sole city accounts receivable are okay. We're willing to accept understatement of up to 50,000, or for that matter, overstatement of up to 50,000. And just using my computer camera. How many people use those other cameras in the room? I didn't think so. They don't work very well. No. So, oh well. My computer camera works just fine. If I have to move my computer a little bit, that's okay. What would we conclude about accounts receivable up here? Are they fairly stated or not? Yes, they are. Here's why. The potential amount of error, 33,000, is well within the bounds of tolerable misstatement of 50,000. We're okay. So accounts receivable are fairly stated. Everybody with me on that? Right? Now, let's look at the next scenario where there are errors. By the way, if there are errors, that's going to push these misstatement bounds out. So these misstatement bounds will be pushed out. It might be more likely, therefore, that one will be greater than tolerable misstatement. I will show you how. So number 2, when errors are found in the sample, we must now consider overstatements and understatements respectively. Calculate the upper misstatement bound and lower misstatement bound respectively. So let's assume the following errors were found. Found them in 4 different accounts. There are the account numbers, which really don't mean a lot to us here because we don't sample those. But in account 103, the book value is 2,000. The audited value is 1,800. So the amount of error is 200. It's an overstatement, so it's positive. The percentage of error, in other words, the error divided by the book value, is 10%. So this $200 divided by $2,000 is 10%. And I'll show you why we need that percentage of error in just a bit. Just trust me for now. Then account 328. Book value of 1,000, audited value of 1,100. It's been understated. Book value was $100 too small. That's why that $100 in parentheses. Now the percentage of error, or error divided by book value, it would be that 100 divided by 1,000, or 10%. Understatement is in parentheses. Then account 573, book value of 1,200, audited value of 900. It's been overstated by $300, or 300 divided by 1,200 gives us 25% percentage of error. Then account number 791, book value is 800, audited value is 700. That book value is overstated by $100, or 100 divided by 800 is 12.5%. Are you okay there? All right. By the way, do you think it's more common to have more overstatements than understatements? Yes, it is. Clients like to overstate accounts receivable. Now, here's another number that we're going to need, just trust me on it for now. We must calculate the increase in the precision limit resulting from each additional error. We're going to refer to table 15.9 again. We'll count to the higher of the number of overstatements or understatements present, which would be 3 overstatements in our case. So I'm going to go number of errors 0, 1, 2, 3. I will look at the precision limits for these and the difference or increase in each precision limit. So what do I mean? I'll show you here in the book. So let's go back to the sample size of 9. Then we're going to look at 0 errors. We have precision limit of 3.3. 1 error, a precision limit of 5.9. 2 errors, precision limit of 6.9. It keeps going up. We think there's a greater percentage of error in the population with every additional error we find. Makes sense. Then if there are 3 errors, it goes up to 8.4%. Let me bring those numbers back here to the handout. So precision limit starting off at 3.3%, same thing as 0.33. The increase in the precision limit, well, from 0 up to 0.033. Find 2 errors. This goes up to 5.2%, 0.052. Subtract 0.33 from it. We get an increase in the precision limit of 0.019. Find 2 errors. Well, actually, they changed this table a little bit from the previous edition, and I pulled this number from the previous edition. It was 0.068 there, 6.8%. In our book, it's 6.9%, 0.069. Do you think we're concerned about a rounding error of that magnitude? No, I didn't even bother changing this number. So the increase in the precision limit, if we subtract, is 0.016. So we think there's an additional 1.6% of error in the population due to this second error we found. Then error number 3. Precision limit is 0.084. That's an increase, again, of 1.6%. So these precision limits keep going up at a decreasing rate. Those precision limit increases are reflecting this upper tail of the normal distribution of the so-called bell curve, because it is decreasing at a decreasing rate. That's where those come from. So for every extra error we find, we think that there is just a little bit more total error in the population and that magnitude of the increase keeps going down. That's where they come from. Next, we'll calculate the upper misstatement bound and lower misstatement bound using the overstatements and understatements respectively. We'll see that one rather confusing part of this may be the unit error assumptions. I will show you these. These are the percentages by which we found the above accounts to be misstated. We start off 100% by convention, which is given in the figure we computed earlier for no errors. We note that the remaining unit error assumptions are ranked from highest to lowest. I will show you in a second. When multiplied by the precision limit increases, which are also from highest to lowest, as the curve of the normal distribution decreases at a decreasing rate after the mean, we'll get to the highest possible misstatement bounds. This is in accordance with conservatism. And the following table, the error bound proportion, is a product of the three previous columns. What do I mean? All right, so I've got a couple of panels to this. First, overstatements, second panel, understatements. Overstatements, I have 3. So I start counting in errors, 0, 1, 2, 3. Increase in precision limit, we just calculated these, 0.033 up to 0.016. We'll multiply by the population book value of $1 million. Unit error assumptions start off 100%, then go for the highest percentage of an overstated account we saw. It's 0.25, 25%. Then go for the second highest, 1.25. Go for the lowest now, 0.10. So I've taken these again. I went from highest to lowest. Just like these increases in precision limits go from highest down to lowest as well. So this gives me the highest possible so-called error bound proportion, or greatest amount of error that we calculate that may be possible. The first one is the same 33,000 we saw. Then the second one pushes it up by an additional $4,750. Next error we found pushes up by $2,000. Next error we find pushes up to $1,600. So the initial upper misstatement bound, or initial upper confidence limit, is going to be $41,350. So this upper tail is going to be pushed out to $41,350. I will adjust that for a reason in just a moment. So it pushes it out. Now we're still okay, we're still under 50,000. Do the same thing with understatements. We add 1. So errors, 0, 1. Increase in precision limit, take the first 2, 0.033, 0.019. Again, multiply by the population book value. Now by the unit error assumption, starting off at 100%, then we had one understated account. It was understated by 10%. Then the error bound proportion, starting off at the initial 33,000 we saw. Now we add 1,900 to it. So the initial lower misstatement bound is $34,950. So it pushed this lower tail out to $34,900 because there was more error. Does that make sense? Just push it out. Then finally, we'll adjust the misstatement bounds for offsetting errors. And the theory is that in an overstated account, some transactions going into it during the year were understated. And then for an understated account, some transactions going into it during the year were overstated. So we're going to subtract an adjustment for each misstatement bound, which reflects a type of mean of misstatements for the sampled accounts. So we're going to be a little bit less conservative here. We're going to adjust just a bit, and let me show you how. So in this case, the adjusted upper misstatement bound, it was initially $41,350, but now we say that might be a little bit high because some individual transactions going into this overstated account, or at least the ending balance was overstated, but some transactions going into it during the year may have been understated. By how much? Here's the type of mean. We look and we see that we discovered one account was understated by 10%. Take that 10% or 0.10 and divide by the sample size of 93 to get a type of mean. Multiply that by the population book value of 1 million and subtract it off. So that adjustment factor brings us down by $1,075. So we take that upper misstatement bound to be $40,275 now as adjusted. Let me erase that allowance for sampling error because it's already been done for us in what we just did. So we say that this adjusted upper misstatement bound may be reflecting a maximum error of the population of $40,275. Looking at this upper tail, we're still under the tolerable misstatement of 50,000. Would you still say we're okay? Yes, we are. Now let's do the same thing with the adjusted lower misstatement bound. It was $34,900. We reflect that maybe that's a little too much. Let's subtract off an adjustment factor because in this one understated account, some transactions going into it during the year may have been overstated. So let's look at those overstated accounts receivable to give us an idea of how much may have gone in the way of individual transactions which were overstated. So we had one overstated account receivable of 25%, one of 12.5%, and one of 10%. I take the corresponding decimals and I simply add them together and divide by the sample size of 93 to get a type of mean. Let's multiply that by the book value of $1 million and subtract it off. When we do, we come up with an adjusted lower misstatement bound of $29,792. So we think there could be as little as $29,792, a misstatement. So total accounts receivable could be understated by as much as $29,792 based on this sample. Would you say we're still okay given the lower tail? We are, because we were willing to say that it could be as much as 50,000. We're way under it. Lower tail's okay, the upper tail's okay. So our conclusion about accounts receivable is that they are okay. They're fairly stated. So just under that, therefore, we believe that the true population value is between $959,725 if we subtract off the upper misstatement bound, because that's how much overstatement could be in the population, and $1,029,792 if we subtract off, or rather if we add back, how much understatement could be in the population. So notice we subtract the adjusted upper misstatement bound because that's the maximum amount of overstatement we expect the population. Conversely, we add the adjusted lower misstatement bound because that's the maximum amount of misstatement that we expect the population. Subtracting and adding these amounts respectively will reflect the expected population range. Okay. So it may seem a bit in reverse, but trust me, it's true. Okay, that's why I wanted to say that. And why I bolded subtract and add. You'll see what I mean when you go back over this. So now decide upon the acceptability population. Ours was acceptable. It was fairly stated. Here's why. If both the upper misstatement bound and lower misstatement bound are less than or equal to tolerable misstatement, just like in our case, then the auditor concludes that the ending account balance of the population is fairly stated. It's okay. No adjustments need to be made before a clean opinion is given. Now, on the other hand, if either the upper misstatement bound or lower misstatement bound exceeds tolerable misstatement, in other words, one of these two tails in our confidence interval had exceeded tolerable misstatement, now we have trouble. What do we do? Auditor must take action. The best action is to request the client to correct the errors found. Fix them. Well, number two, if specific errors cannot be corrected for some reason, the account balance may be adjusted in order to bring the error it still contains under tolerable misstatements. Not the best of all worlds, but it's sometimes done. Or number three, the auditor may take a bigger sample in hope of getting items which are not misstated. It's rarely appropriate because we're going to get just more of the same. It's kind of like garbage in, garbage out of a computer. You're just going to get more garbage here, piled higher and deeper. Number four, if all these fail, then the auditor is going to have to do this. That audit opinion is going to have to be modified. It won't be clean any longer. Do you think the client likes that? No. All right, so that's PPS sampling. Any questions about that? Again, much better than other types of sampling techniques that did not automatically stratify by population size, and those older sampling techniques have been replaced for the most part. By the way, PPS sampling can be used for other than dollar amounts too. For example, some years ago, there was a study done in the LA County public school system in which they chose schools to be sampled based on the size of students there. So the student body size. The greater the student body, the more likely that school was to be sampled because they matched random numbers up to the cumulative number of students in the student body. Does that make sense? Just like for accounts receivable. Now, I bear in mind some years ago that I had a student, not an accounting student, who said to me in principles of accounting, she said, when she wasn't doing so well in there, she sighed and she said, I'm a product of the LA County public school system. And I didn't come out and say it, but I thought, oh, that explains it. I didn't say it. I'm sure there are some perfectly good schools there. But do you think that school system has the best reputation? Not really, no. Just kind of like some school systems in the country, yeah, like Detroit, I always think of there. Yes, and I know there are good schools in Detroit, even in the city. In the suburbs, definitely, but even in the city, there are. That's just another school system that often gets bashed, I'm afraid. Yeah, my poor mother, a product of the Detroit public school system. All righty, so no questions about PPS. Again, you will not be tested on this. but instead just do my accounting lab assignments and you'll be fine. All right. So speaking of the test, there is just a little bit more in the way of material that I need to go over. And that is some material in chapter 16, which is about accounts receivable, and a little bit of material in chapter 23 about cash. So that will need to be on this last exam. So I was thinking I could do this. I could go ahead and record that for you. It would be easy enough to have on a video. And you could watch that. And then later, you could do the first exam. Or I'm sorry, second exam. I've already done the first exam, please. But would you prefer to do that? Everybody online? Does that make sense? Okay, I'll get it up tonight. So sure, I'll post it tonight. So what I'll do, I won't get to record that video though by tonight. Goodness. Although you'll be okay, actually, if you did want to start the exam, by reading the handout for those, you would be more than fine. Okay. If you run into any snags while going over the handout, just let me know. So yeah, I'll get that exam up tonight. I'll get that video recorded if possible tonight. I'll do my best, okay? All righty, sure, no problem. Yes, Ken.
For my accounting lab, for the chapter 23 stuff, it says it's due in 2018. I take it you still want us to do it.
Well, you don't have to do it. How about that? Yeah, I know why that shows it because I did not assign it for this term. Yeah, so goodness, I guess I haven't assigned that in 2 years. That's where that date came from. My accounting lab, excuse me, when you roll a course over to the next semester, it may or may not automatically update the dates. It's supposed to, but oftentimes it doesn't. So it didn't update those dates. That's what's happened. So you don't have to do homework on those chapters or quizzes either. How about that? Unless you just want to. Okay, I'll unassign those. Okay, so yeah, I will take care of the remaining material then, and I'll extend the due date of that exam. So you won't have to worry about it over Thanksgiving if you don't get it done before. I know, Ryan, you're an early bird, so you might get it done. Yeah, or we could just do it yet tonight. After the advanced managerial exam?
No.
I'll actually beg here, please.
Okay, so you'll have plenty of time to wish to do it. All right. So do you have any questions or anything? You okay? All right, well, that's it as far as live classes go. So we're all done, except for the online stuff. So as far as online stuff will go, I'll get that video up for you. And then you will also, of course, be recording that presentation. I sent you the email about it. It won't take you that long, and just post that, send me the link, using any platform you like. And other than that, if you have any questions, go along, just let me know, okay? Yeah, this semester we actually had 1 extra week beyond what we normally have. So as they adjusted the calendar, they did that for us. And so that's good. We have plenty of spare time. Very good. Oh yeah, the other thing online, I wanted to get you to do this live or record. You may rather I record asynchronously, just a little bit of information about payables. And for that, you would certainly not be tested on it or anything like that. But it could appear on the CPA exam. You can answer it based on receivables, but maybe this will get you a couple of more quick and easy points on the CPA exam. So I will record that for you that you can watch at your leisure. Again, you will not be tested on that. There will be no My Accounting Lab assignments on it either. All righty. So any questions? Okay. Well, for those of you live, I'll see you remotely soon. And for those of you that are remote, I'll see you remotely soon too. Okay. Take care. Bye-bye. Have a great Thanksgiving. Yeah, time to go away.
Yeah.
I'll take my first flight since March
Oh, where are you going?
to my hometown, Indiana.
Oh, nice.
And I will not fly in Chicago because they have a quarantine there. Fly into Indianapolis instead. Yeah.
I'm going to have to quarantine when I get back.
Oh, Rhode Island. Did they finally?
Massachusetts, yeah.
Oh, you're flying into Boston
Yeah.
instead of Providence, but
I don't even know if I could get in Providence right now. I think Rhode Island is quarantined from Massachusetts and Massachusetts
Oh,
is quarantined from Rhode Island. I don't know.
oh, that's right. I saw on the
They keep
map.
playing each other.
Rhode Island's like a little island, pardon the pun, to itself. Yeah.
It's so weird. You can literally drive from Massachusetts through Rhode Island and back into Massachusetts, but they're quarantining from each other right now. I don't understand it. It's so
What if you take a
weird.
boat to Rhode Island?
The
It's ridiculous.
number of places that are quarantined. I'm pretty sure there are only like 3 states that are allowed to go to Massachusetts and not quarantine right now. It's insane.
Oh, for heaven's sake. What a mess. Thanks. Take care. Bye, Julia. Hi, Ken.
Questions.
Of course.
The first one for the abstract. So I don't know exactly like the topic was what's it on? Like, I guess that's,
Anything you would like.
so like if I wanted to do like, does it have to be like auditing topics or can I do like something that involves sports?
As long as it ties into auditing somehow.
So, okay, is there like, just out of curiosity, what is one?
Yes, NCAA agree upon procedures engagements, which are now done every 3 years for colleges.
Okay.
That's an example of something.
My other thing is, so are we writing the 250 and then doing a presentation on that too? For the abstract?
Incorporate that into your presentation.
Okay,
And it won't take you long. You'll just say a minute about it.
right, okay. All right, cool. Thank
Okay,
you.
sure. Let me know if you have any more questions, Ken.
I have a question about the presentation part as well. So we have to make one presentation about the fraud that we encounter or that we find online about one company or
Yes,
anything that we encounter pretty much like that
Anything.
interests us.
exactly.
And we also have to voice record ourselves for that part. And besides that, we do an abstract of 250 pages. So does that have to be relatable or not?
Does not.
Okay.
It can be totally a different topic. if you like.
Okay, and that's for the class, but then I also have a question for Beth. So since we're getting closer to end of the semester, I will be emailing to the registrar to confirm the GPA standing for the students. So in case if they're not like being able to get back to me, I'll be CCing you in the email.
Okay,
And if not,
sure.
maybe I'll email you in case if you could just ask them the GPA requirements.
We'll figure it out.
Okay,
You
thank
bet.
you. Have a good day,
Anytime.
Dr. Kelly.
Thanks. You have a great Thanksgiving and
You too.
see you virtually.
Yep.
All righty. Bye-bye, Eddie.